Alan Biel, welcome back to the show, my friend. I've gotten to know you very well over the last couple of years as we are both members of Multipliers. And man, it's always good to kick it with you. We've hung out in Scottsdale. We've hung out in Mexico a few times, gotten to break bread over many dinners. So it's exciting to have you back on the show, talk about really some killer stuff you're doing in the real estate game. I listened to you and Billy Alvaro, another friend, mastermind member of ours. And, I know both you guys, so I could just call you guys whenever. But you guys were talking about all this cool stuff. And I'm like, man, I got to get this cat back on my show. He's got so much value to offer. So thank you for coming back on the show. And I'm looking forward to chopping up today over the next 30 minutes on some cool stuff you're doing in the real estate business. So real quick, before we get into that, if people didn't listen to your previous episode, give everyone like the high level overview on how you got into real estate. And then we'll start covering some of the stuff you're doing now.
Greg, I'm so pumped, man. It's good to catch up with you. We were just talking right before this and it's like, gosh, probably should have been recording that.
All right. Yeah.
I don't know. My name's Alan. I feel like I'm a regular guy that chose to get into real estate investing a long time ago. And real estate's been really, really good to me. And so I do my best to make the most of the opportunities that I have with real estate. And if I can help other people, I do. But I would say, my wife and I kind of flipped our first house in 2005, 2006. So that's going on like 16 years ago now.
17 years.
It was actually at that time, that was so long ago, Greg, I don't know that you would know this because I think you just turned like
27,
16 years old.
Oh, at the time. Yeah.
Funny. It's amazing what you've done in a short amount of time. But that was actually before like YouTube, for example. So as years went on, we learned a lot about how to flip houses thanks to YouTube. But I think back then there was like maybe one TV show about flipping. So I don't know why I'm bragging about being so old. But anyway, so that's kind of how it got started. I think I remember walking away from the title company with a check in our hand for $33,000 in 2006, beginning of 2006. I couldn't believe it. It's more money. That was about how much money I made from my job per year at that time. A little less, but still, we were extremely young and had these big dreams and stuff. So that's how it started. Bought my first couple rental properties the year after that, and then really started playing the cash flow game. So I spent almost 10 years playing what I call is like an old school Robert Kiyosaki cash flow game of just creating financial freedom with rental properties, which is a whole different story. And then in 2015 or 2016, started flipping houses full time. And then 2018 started wholesaling houses full time. So I feel like I know this for sure. I've made over $1 million in a few different ways each in real estate. And so that's good. And since then we've done, I've had a wholesaling company do, $1 million, $1.5 million, $2 million per year in profit. Now I'm back to rehabbing and actually thought I was going to be back into flipping, but I've actually been keeping all the properties lately, which is an interesting, I guess you'd say it coming full circle, but obviously with a lot of different experience and different resources now. So it's been fun. It's interesting to kind of see that journey. But telling you that story now, Greg, now I feel a little older than I felt before we started this. So let's change the subject.
So let's jump into the rentals. So you and Billy were talking about something, you guys were talking about you were sharing your strategy on rental property investing when it comes to getting lines of credit instead of doing the traditional BRRRR, which ends in a refinance. So I mean, the first show we didn't really cover that. So I remember you told me about this in Tulum like 2 years ago, and I was like in the middle of doing a refi and I was like, oh, should I call my banker and cancel? I ended up doing the deal. But so just kind of walk through this line of credit strategy, because a lot of people listening do have rental properties and they drink the BRRRR Kool-Aid, and I still do that strategy. But now after you introduced me to how to do this line of credit exit instead of a refinance, there's a lot of upside to that. And it seems to me like it's more of a logical way to maximize your equity versus having to have that note that's just going to be there for 15 or 30 years.
Sure. I'm happy to talk about it. I haven't quite figured out the best way to package this. I don't, and I
Sounds
certainly,
like an offer to me in the future.
yeah, I don't have an offer or anything. And I also feel I'm a little worried about almost like encouraging people to do something, because there are pros and cons to everything,
Yeah.
as we all know. What's funny is, so there's two parts about the whole line of credit strategy. There's the mindset part, and then there's the practicality, right? There's the actual, like, what do I do? What do I not do? And how does it work specifically? And so it's hard for me to explain, because most people, I don't think, including myself, fully understand the mindset of money, of finance. In fact, I think it was you and I, Greg, that were talking about a book called, what was it? The Psychology of Money.
Oh yeah, it's a great book. Yeah.
Which is a bit more about investing and about, that, but still, I mean, it go all the way back to Kiyosaki, who was referring to things like emotional intelligence and financial intelligence back in the 90s, because he learned it in the 70s
From his rich
about,
dad.
yeah, about financial intelligence, emotional intelligence. So I think we have a misunderstanding in a lot of areas, again, myself included, about money and finance, that there's a reason why the banks own the tallest buildings in every town, and some of us don't.
Yeah.
So I think
So
they know
true.
things that maybe we don't. So anyway, I don't know how deep you want to go into this. You'll have to let me know, but I will tell you, it starts with the mindset and the traditional way that we view mortgages. And in the United States, it's very much a United States thing. The way that we view mortgages, we view them as safe. We view them as like, the whole name of the game is like, how low can I get my payment?
Mm-hmm.
And while wealthy people, and I don't even just mean the billionaires and the trillionaires. I know, Greg, we even know people that maybe they're not billionaires, but they're, very wealthy, and they look at it differently sometimes. They don't look at how low can I get my payment? Who cares about anything else? All I care, like, but that's the traditional BRRRR strategy that you're talking about, is like, how low can I get my payment so that I can make as much cash flow as possible? And that's fine. There's nothing wrong with that. But there's this little fun thing with mortgages called reverse amortization that I first became aware of when we bought our first house a long, long time ago. And it is a tricky little thing where that means you pay the vast majority of interest on the front side of the loan.
Yes.
So on a 20 or 30-year loan, right?
It's crazy. If you really run the math and like get a financial calculator out, you're paying double what the house is worth.
Oh, more than double. Oh, it's not even close.
It's crazy. Yeah, more than that. It's insane. You're like, holy smokes.
Over the course of 30 years. But so if you take $100,000 house and you're like, okay, over 30 years, I'm going to pay $275,000 for this house over 30 years. And you're like, okay, well, whatever. But my cash flow each month is this, and I'm making that.
Yeah.
That's one thing. What's even worse is so you're going to pay $275,000, say, for a $100,000 house. That $175,000 in interest is front loaded. It's front loaded. I'm not making this up, and this is not a conspiracy theory. I'll get to my conspiracy theories later on in the podcast, probably, but that's not what this is. This is a chart that they give you when you sign off on a mortgage.
Every mortgage, it's the same thing. I do it all the time. Yeah,
and it tells you your payment is $1,000 of principal and interest, and 900 of that is going to interest, and 100 of that's going to principal. And we all just sign off on it, because it's like, whatever, who cares? Because I'm getting and I'm putting air quotes here, I'm getting a 3.5% interest. I'm getting 4.5% interest. And we're like, guys, do you really think you're paying 3.5% in interest when $900 is going to principal interest?
Insane.
And 100, like, wake up. So anyway, the first part is the mindset, and then the understanding of, like, the banks aren't owning the tallest buildings in every town because they're only making 3% on their money. Wake up. Like, that, you can't buy buildings on 3%. Inflation is like quadruple that just this year.
Yeah.
So, or probably more than quadruple if they would publish real numbers. But anyway, so I think it's just a misunderstanding of money and of finance and of how the wealthy make money is the first thing. So anyway, I just don't know how. I mean, do you want me to? I'm like in the clouds, right? I'm in like the 40,000.
Oh, I love it, because it's good that you started here, because then when we go into the actual like mechanics on like how you do the line of credit instead of the refi, people are going to understand why that makes sense to do most of the time versus just drinking the traditional Kool-Aid. So when you do the line, like, what do you, so let's say, I'll give you an example and then I'll have you fill in the blanks. This will be more easier. I'll tee it up for you. So you buy a house at a discount, you buy a house worth 200 for 120, you put 20 grand into it, you're in the thing for 140. So your basis is 140. You got 60 grand of equity now. It's a 200 house. Your basis is 140. Most people will say, let's go refi this thing with Kiavi. We'll take our 140 loan out, probably leave 10 grand in the deal. So now my cash on cash return is based on $10,000, not based on, $50,000 if you put 20% down.
Yep.
If we were going to do the line of credit, how does the line of credit work? And then how does it benefit the investor? Because you were saying some stuff in Tulum and I was like, yo, this makes a lot of sense because there's so much more utility with it versus a refi loan.
You want to do an example where there was a lender involved on the purchase price and rehab?
Yeah. There's a lender involved. Yeah.
Cool. So, because full disclosure, I'm doing this strategy at this point in my life with cash purchase, cash refinance, rehab, and then going and doing it. But in essence, it's going to work
the same,
right? As you know, it's going to work the same way. So in your example, what would happen, the only difference that would happen is we would do what you said and buy it and rehab it. And we would go to a lender, we would find a lender that would agree to do a line of credit that carries a balance instead of a mortgage. So tell me the numbers again. What are we all in at 140?
140 is our basis.
And it's going to appraise for sure at 200?
200 easily, probably more, but let's just call it 200 to make the numbers.
Right. You hopefully more if you did that nice of a rehab, right? I know you rehab houses like I do. So, so if what we can do is if we can find a lender, and they're not everywhere, but they're virtually everywhere, that would agree to doing a line of credit instead of a traditional mortgage, and go to a lender and say, listen, I owe 140,000 to, I don't know who do you owe them?
Lending home. Let's call it lending
home.
Whatever,
Kiavi. I'm looking for a lender. It's going to appraise it at well over 200,000. We'll just call it 200. I'm just looking for a lender where I can set up a line of credit so that carries a balance on it. So I need a lender that will pay off lending home the 140,000, and I'll carry that balance on my line of credit. And then let's say, Greg, just for fun, that house appraises at like 210 or something, or 220.
Yeah.
Let me do the numbers. In the great state of Texas that I live in, the most that you can refinance at is 80% of appraised value. So every state has different rules on refinances, as we all know. It's a state by state thing. So you need to know your percentages. But anyway, in Texas, it's 80%. So
it's the max you can get on a refi.
It's the max you can get. And it's I think the lowest, maybe there's a couple states that are only 75%, but I want to say 80% might be the lowest of any of the 50 states, which is not, it's not a bad thing, right? Like it's a protection measure.
That equity buffer.
Yep. Equity buffer. Right. So for the lenders, I don't know if it's good or bad. I'm not that smart of an economist, but so if it appraised at 220 at 80%, that is 176 grand. So we're already in a really good spot there. So we can say, listen, hey, it appraised at 220. Are you guys open to doing $176,000 line of credit for me instead of a traditional refinance, whatever. And most banks, this is just a side note, Greg, most banks, my opinion is that it's none of their business how much money I put into the
100%. When they count your money, I go to the next bank.
Amen. Thank you. So I know you and I've never talked about that, but from a practicality and privacy, because it doesn't make sense anyway. So, hey, anybody out there that has been through this, and the appraiser will ask you, and the bank they'll flat out ask you.
I know.
They will ask you, and you can answer. I'm not telling you what to say and what not to say. You gotta have to say something when they ask. But at the same time, I want you to understand the mindset here. If you were in charge of that rehab and you didn't pay yourself, if you were the GC, or if you were the architect, or if you were the interior designer and you didn't pay yourself, there's $10, $20, $30, $40,000 that you could have spent that you didn't. So when they ask how much I spent on a rehab, if I was involved in it with the good taste that we have, and the smart decisions that we make, and the way that we're able to skimp on cost and on certain areas, but then we spend more on other areas, I don't like it. I don't appreciate it when they ask, And I don't think they should. I'm right there with you, Greg.
That's like a cash buyer asking how much you're making on an assignment. I'm like, who cares? I usually tell them if it's $1 million, would you get pissed? I'm like, whoa, it's like, oh, it's not $1 million, it's 50. So sign it
it's
up.
only 50. Right. Yeah. Nice. I love those numbers, Greg. And you use the old principle of anchoring there.
100%.
Is quite effective. So anyway, so it appraises for say 220. So we're looking for a lender who is cool doing $175,000 line of credit, but we need them to take $140,000 and pay off lending home. So I'm going to have $140,000 balance that I owe on a $176,000 line of credit. In using that example.
Got it.
So did that answer?
No, that makes sense. No, that makes sense. So let's say they're willing to do the 176. So now we appraised at 220. They're willing to do 176, which is 80% loan to value. Okay. The 140 gets wiped out. Now lending home is paid back off. We have a BAP now, like we owe the bank, we still owe the bank money because they paid off the first lender. But now with that line of credit now, how does that work? Like, what is the payment structure? Because you made a good point in the beginning of the show where the amortization schedule is so not in your favor on a traditional mortgage product. With a line of credit, you have principal and then obviously you have interest, but it's structured completely differently, correct?
Yes. So what I love, look, guys, there's pros and cons to everything. And Greg, I don't know how much, does your audience like numbers? Do they like this kind of stuff?
They do like numbers. They like numbers and they like learning strategies that not a lot of people talk about. So I'm sure they're licking their lips right now like they just ate a barbecue dinner, you know? They're like, oh, this is, yeah.
Did you just use a reference to barbecue just as a shout out to me being in Texas? Thank you.
I might have. I was actually just in Dallas like on Monday and Tuesday. So I just got out of Texas. It's a great state.
You got to reach out.
Well, you're on the other side of the state, right?
I am, but Texas is so big. You know, it's like 13 hours east to west. It's about 13 hours north to south. But we have, airports and stuff. But so the way that the interest and the principal, you guys, this is where I think people get confused on lines of credit because they're just not talked about very much. Think about this line of credit that's secured by a house. Like, so all it is it's a secured line of credit. But it works the same way that any line of credit would work. If you had any line of credit, forget the house, and it was a $175,000 line of credit, and you owed $140,000 as a balance, then just think about it like that. So at this point now, you can forget the house. It doesn't matter anymore. It's a line of credit. How they would calculate your payment on any line of credit is they take what your daily balance is. So if there's 30 days in the month and your balance is 140,000 every single day, well, that's a pretty basic calculation because they would take pros and cons is what I was going to mention, Greg. Your interest rate is going to be a little higher on a line of credit than it's going to be on a mortgage. And this is where people get lost. This is where they get confused. They're like, no, I want to lock in the 3.5% while I can. I don't want to do a 4.5% line of credit. And it can fluctuate. That's the question I get all the time. People are like, can't it fluctuate? Sure, it absolutely can. Is Alan going to look like a fool in the next 12 months? Maybe, because interest rates going to keep going up, allegedly, right? The Fed keeps raising things right now. We were bragging a couple of years ago about how they kept lowering things. It's going to fluctuate. Get over it. It's a line of credit. All right. When I tell you the benefits of this, that so far outweigh the interest, the percentage that you think you're paying. Remember, it's just a percentage you think you're paying because they're front loading all the interest anyway.
You're getting smoked no matter what. You just think you're not getting smoked. They're smart.
You're getting smoked. Remember, if you start out paying $900 out of every $1,000 to interest, if you refinance that house or sell that house in 5 or 6 or 7 years, which is the average amount of time that every American refinances or sells a property, if you do that, in that first 7 years, you paid like 70%, and I'm just making up numbers. If you paid like 50% of the total interest for the 30 years in the first 7, which is probably what it is, you just got smoked on interest. And now you're going to refinance it and you're going to start the 30 years over again.
All over again.
This is what in my opinion, this is what wealthy people are talking about, that average. And I'm throwing myself in there. I'm not saying I'm above average, but speaking as a fellow average investor, and I don't own the tallest buildings in these towns, my theory is this is the kinds of things that people with a lot of money are talking about. Is like, I don't want to pay. Now you're going to pay, instead of paying 175,000 in interest over 30 years, you're going to pay 275 or over the next, or 375 in interest over the next 30 years, right? Because you refinance, you started that thing over again. So anyway, I'm not preaching at people necessarily and telling them what to do. I'm just explaining the pros and the cons. So the downside of a line of credit is, yeah, the interest rate, the bank could reserve the right to change that interest rate. You're not going to be locked in for 10 or 20 or 30 years. You're not. Just remember what you're locking into with the traditional mortgage. You're not locking into what you think you're locking into anyway, is my opinion. So anyway, let's say the interest rate is, let's just use round numbers, Greg, and the interest rate is 5% on the line of credit.
Sure.
So we've got a $140,000 balance, and the interest rate is 5%. The annual interest rate is 5%. So we just do a basic, a little multiplication. What's 5% of 140,000? It's $7,000
a year.
So per year. So you divide that by 365 days in the year, correct?
Yep.
And that comes to $19.17. I really feel like I'm losing your audience.
No, you're not. You're not, man.
Include a PDF, like a spreadsheet or something.
This is why these are evergreen. People can listen to this more. Like I learn best from repetition. Seriously.
There you go.
Yeah.
Well, so my numbers say that daily interest rate is $19.18.
Okay.
So we take that and we say there were 30 days this month. So this is what the bank does. This is how they calculate it. They say, Alan, you used $140,000 for all 30 days, and it's 5% is our rate that we gave you. So now we multiply the $19 times the 30 days, and we owe $575.34 to the bank.
Interest only, though.
It's interest only because it's a line of credit.
Exactly.
So your payment is minimum payment is $575. Of course, lines of credit are attached to like a checking account. It's how all the banks do it, right? So there'll be a checking account there that you'll want to open, and then there'll be a line of credit. And there's some cool, sophisticated stuff you can do. And a friend of ours that's in our mastermind group, Greg, he took my advice about a year and a half ago, and he reported back to me this year that he did it. And he was able to exactly the strategy that we're talking about. And he was able to get not just the checking account hooked up with the line of credit, but he got what's called a sweep account, where every time money goes into that checking account, say you want income, you could put the rental income where it goes directly into that checking account. It'll instantly, at the end of that business day, automatically push it to pay down the line of credit.
Ooh.
To effectively lower the daily balance. You could do that imagine if you did that with all of your wholesaling income that you made. So every few days you close in a wholesale deal or a flip or whatever, and that money is getting direct deposited into that account instead of whatever account you've been using, where the money's just sitting in a checking account doing nothing. Oh no, sorry, it's not doing nothing. They are graciously paying people 0.02% right now.
Generous thanks.
On checking accounts and savings accounts, which isn't that nice. So that the banks are willing to pay us 0.0. And guys, I mean 0.02, meaning 0.0002 is the multiplier. Is
like basically not even one, like almost basically nothing. That's like the redneck version of that. Like basically they're paying us not even close to 1%. Like
0.02%.
Insane.
Or whatever, right? Whatever it is. And look, I could be wrong. Maybe it's not. Maybe it's 0.04. But I don't think I'm that far off. Everybody out there, listen.
Check your statements.
Look at your statements, because they have to tell you by law. And we're all very excited about it. We're like, oh my goodness, look at all this money I have in the bank. Like in our culture, in the bank is like a phrase. It's like, oh man, that's cash in the bank. Yeah, it's amazing. Like, and every day that the money sits there in the bank, since we live in a world now of like 10 or 15 or 20% annual inflation, every day that your money's sitting there in the bank, you're going negative 10 or 15 or 20% in net worth. Great. So great job.
Great.
And thanks. Not just great job to us as investors, because I'm picking on myself too, but great job to our wonderful, the powers that be that created this amazing thing that we call inflation. Hey, the good news about inflation is if you're a real estate investor and you act, and I mean an actual investor that actually buys properties, then the good news is when you're an investor and you own real estate, we don't call it inflation, we call it appreciation, but it's the same thing. So we get to participate in the inflation when we're owning properties. As many of us have seen, a lot of us look really smart over this last year and a half, right?
Oh, on paper, man, some of these rentals I have, I look like I'm Ray Dalio's junior, you know?
Isn't it great? So, yeah. All right, so let's circle back. So I've got my calculator right here and it says $575 a month is my minimum interest payment. So what would, Greg, look, in your experience, if it was a $220,000 house, I'm assuming it's what, a 3-bed, 2-bath house, just pick a number. How much is that renting out for in your experience?
Oh, in my market?
Fully renovated 3-bed. That's
$3,500 to $4,000 a month. I mean, I live in an expensive area.
No, but a $200,000 house.
Oh, yeah, $2,500 a month. Okay. Probably more.
If it's renting out for $2,500 a month, and goodness, haven't we seen rent prices skyrocket?
Oh, that's what I'm saying. I mean, the rents are around where I live in California. It's like, it's insane. Rent's insane. So yeah, no, minimum 20. I mean, even in New York, yeah, 2,600. So yeah.
For this example, we'll say it's $2,500 a month. Your minimum payment, according to our calculations we just did, so we know it's correct because it's Alan's iPhone calculator. Your minimum monthly payment is $575 on that $140,000 balance on a line of credit. So what I believe you should probably do, first of all, is deposit all $2,500 of the rent money straight into that account and effectively lower that balance. So you're going to owe $575 in interest. So the other couple $1,000s that you have, like, pay it down on the line of credit to where the balance is not 140, it's 138.
Yeah.
Right? It's 138. And then the next month we would rerun our calculations, right? And we would take $138,000 times 0.05. So we owe now $6,900 a year in interest divided by 365 times 30 days in the month. And next month we only owe $567 instead of $575. And so that's the first thing. So that's kind of how it would work, right? This is like a microcosm though, Greg. I do this at scale now. I mean, I've got a lot of these properties that I've been doing this with. But just using one house, one line of credit example, this could be how it could work. The way we're very granular though in this example, if we back up and go big picture though, where it gets way more interesting is what I mentioned a few minutes ago, which is that what are you doing when you have, I mean, Greg, when you wholesale a deal and make 10, 20 grand, 30 grand, 50 grand, whatever, where is that money going? Well, it's always going into a checking account.
Every time.
And it's going to sit there and you're going to use it to pay for marketing and you're going to use it to pay for your mentors and your coaches, right? Those are always our two biggest expenses, in my opinion, is mentorship and it's marketing, right?
Yeah, but so you can market the right. You pay the mentor so you can market the right way, you know.
Right. So you know what you're doing. So anyway, we've got all these expenses, and right, and like we were talking about the office. I'm in my office right now. I own it, but you know, I pay myself rent on it. So anyway, we have overhead. So we use that checking account typically to pay our personnel and to pay for our marketing and to pay for our mentors and all that stuff. And otherwise, though, the money's sitting there making 0.02%. What we could do is say you've got, you know, Greg, what I've found is the typical real estate investor, honestly, whether they're a kind of a beginner or even more advanced, they've got somewhere between like 30,000, 50,000, 70,000. So a lot of times more than that. I mean, I don't know what you've heard, but like they've got money and it's just sitting in either one checking account or in like several different checking accounts. And it's just sitting there.
Yeah.
And so for me, when I realized like, okay, I could buy real estate, but then I can use a line of credit to do something that I cannot do with a mortgage. And that is I can take that extra $50,000 that's sitting there earning nothing in a bank, and I could move it to this other line of credit. So I could take 50,000, Greg, and pay that $140,000 note down to $90,000. So And if I need the 50,000 back for marketing or for my mentor or for my office, it's a click of amount. You transfer it out of the line of credit. It's a line of credit.
It's not a mortgage. It's not like stuck on you. You can throw, it's not like a monkey attached to your back. You can move it around way more efficiently than a mortgage. A mortgage is a locked and loaded thing. You're stuck with that thing for 30 years, 15 years.
Yes. And if you pay it off early, you cannot access that money that you put in there. And
no, it's just a black hole.
It's a black hole. Liquidity is, that's a big word with a lot of syllables. Liquidity, though, access to your cash is really important as a real estate investor.
Critical.
Whether you're a wholesaler, a flipper, or buying rental properties. And so when I meet really smart people, they're talking more about liquidity than they are about other things. They're talking more about, do I have access to my money when an opportunity comes along and I want to jump on it?
100%.
So that's I would say the bigger thing for me as somebody that buys as many houses as I do. I need flexibility. I need access to my cash. I also think it just happens to be a smarter way to pay debt down. Even if your goal is paying off debt, how much faster can you pay off debt with a 5% line of credit than with what you think is a 2.5% or 3% mortgage? Well, it depends how you use it. If you use it the way I'm talking about, and every time you make extra money, park it down on that line of credit to lower the daily balance or the weekly or the monthly balance, whatever, lower it to where you effectively owe less in interest. The other way to use it, Greg, is when you have several of these. So like if I have, obviously that $575 minimum payment is a lot less than what the payment would have been on.
It makes your cash flow way better.
Yes. So if you do this, say 3 or 4 times, for those of you that own several properties, or even if you own more than that, if you own 10, 20, 30 properties, but you want to try this strategy with say 2 or 3 of them, then yeah, which I would recommend at a minimum, get those payments a little lower, take all that extra cash flow and park it down on one line of credit, right? So we're trying to hammer down, we want to get our payments as low as possible so we can hammer down one. And so you could use it as kind of create a debt snowball and pay things off faster if that's what you wanted to do. But I like it mainly for access to, number one, it's a good place to park cash where my cat. So now I feel like my money's making me at least 4 or 5%.
Oh yeah.
Sitting on that, sitting down. So now it makes more sense, right? Because people are like, what do you mean park it on a line of credit? What do you mean your money's making you 4 or 5%? So this is how I feel like my cash is making me 4 or 5% instead of making me 0.02%. And I have access to it for the next deal that comes along that I'm buying. I mean, we bought 3 houses in the last week, with cash. And so it's
like
good
legit
to have
with
access
cash.
to
Like, yeah, you're going in with a cash offer and it's an actual cash offer. It's not like, oh, I'm going to call the hard money guy up. And it's like, no, like you have the money, boom, in the thing, closed, funded, recorded, done deal,
Yeah, we're not messing around. I mean, we're not, and I've taught so many clients this over the years, Greg, is like, be honest with sellers, with homeowners, but I don't mean the same thing that a lot of these guys, they talk about being honest and being transparent and stuff. That's not what I mean. But so like, I'm at a place now where, we're literally paying cash, and that's not because I'm rich. It's because I've, many years ago started using a little bit smarter strategies, in my opinion. And quite frankly, it's because many years ago, I chose to buy real estate. I'm not some guy that just started out wholesaling to make an extra 5 or 10 grand. We chose to build a wholesaling company in order to control our lead flow back in 2018, 2019, because I got tired of battling it out on the MLS with investors. But I'm not just some newbie that's talking, saying things. I'm trying to think of a nice way to say this.
Yeah, you're out. When you say you're going to buy a house cash, you're going to actually buy the house cash, and you're coming through with cash. You're not going and getting 17 private lenders to gap fund your deal and have
Right.
it be some sort of a bumpy ride. Like you're able to set your situation up with a line of credit to where you can have your cake and you have access to liquidity. You have obviously the ability to buy these houses at will in cash, but at the same time, you're maximizing your cash flow and you're paying down your debt a lot smarter because you're not following the traditional rules of a mortgage, which basically screws you for the first, half of the loan, if not more. because you're locked into a rate, but you're freaking paying $800 a month of interest, which is strictly going into the bank's pocket. Unlike the line of credit, there's so much more versatility to that, and there's so many more ways to spin that around. And ultimately, you can make more money and have more liquidity. It's just a little bit more of a specialized knowledge you have to have. But once you have that, it's like you're unlocking the financial, you're releasing the financial dam to where you can go out and really make calculated decisions and build your wealth faster with having liquidity. A lot of real estate investors are millionaires on paper, but they don't have more than 20 grand in the bank. And I'm like, what good is that? I mean, listen, it's cool to say you're a millionaire on paper, but if you don't have either it's not, you can't pay your electric bill with equity. I've tried. I'm just kidding. Like, you can't. Like, liquidity is king. And when you can do what you're doing, you can literally have the best of both worlds from what I'm getting from you. You
just summarize it. And I think you also just proved my point, which is that this is really hard to explain in this isn't like a one sentence thing. It's really not even a one paragraph thing. But you literally just summarized it better than I did. And so two things I don't want to forget, because I feel a responsibility, Greg. There are downsides to this. There are potential risks. I guess I would have to say that, just in fairness as a disclaimer. And then also I want to circle back to the interest, that just to put a bow tie on that interest, how much we're actually paying in interest. So the downsides, obviously your interest rate can fluctuate. I don't think this is going to happen. But if we go into a time of super, super crazy high interest rates getting jacked up, and you have a lot of lines of credit, that could be an issue. I think I've explained why, because we could rerun those numbers, Greg, at 8% instead of 5%.
Makes sense.
And I'm pretty sure it's still going to be, because of the other variables, I think it's still a pretty smart idea, but people get freaked out by the number 8. That's a high number. And there's also a lot of newbies that think that 5 or 6% interest is a lot. And if you study history, that's not a lot. That's not a high interest rate for a mortgage. I'm sorry to break the news to a lot of people, but that's not a lot. That's just a lot in this crazy, weird world that we live in for this last, 2 years or 5 years or 10 years. But anyway, interest rates can fluctuate, and they obviously do on a line of credit. The next thing is, you're not going to lock in a 30-year line of credit. Like a bank, there's not a bank that's going to say, yeah, here's a line of credit for the next 30 years.
That would not be in their interest to do that.
It would not be. And they're typically a lot of times not even going to do 20 years. If it's your primary residence, that's a whole different conversation. So I've got a lot of buddies that do this for their primary residence, this strategy. So primary residence, you will find banks that will do 20-year lines of credit on that. And they're very aggressive, with their interest rates too. They'll give you a somewhat low interest rate as well. But as we all know, primary residence is a different story. And that's not really the nature of your podcast, I'm assuming. But it's really going to be, depending on what you can negotiate with a bank, it's going to be a very short-term line of credit that they're going to want to then renew with you. Like every line of credit, they're going to want to see your financial statement. They're going to want to renew that every 12 months, every 24 months, or maybe it's every 3 years, or maybe it's every 5 years. If you can really find a really, really good one. There might be some out there that will do 10 or 15 years on an investment property. I'm not an expert. I haven't called every bank in the state of Texas or in the United States. I don't know. But that's a really important principle, Greg, as well, for your listeners. I don't know if this has been talked about on your show, but if you go to a lender and they tell you no, that doesn't mean the answer is no. That means the answer is no for them. If you go ask for something from a lender and you don't get approved, it doesn't mean you can't get approved. It means they won't approve you. It doesn't mean that the next one and the next one and the next one are going to say no. So the cool thing about, we mostly still live in a free country. In some ways, we still live in a free country. So you can still walk down the street to the next lender and the next one and the next one, and you can tell your story, and you can ask for what you want to ask for. And if they don't give it to you, there's 10 more banks, there's 20, there's 50 more that you can ask. And I'm going to go out on a limb and say that you will find people that will do this. And just like contractors, because Greg, you flip houses, So just like contractors, just like employees, if you hire one bad employee, that doesn't mean that you can't hire a good employee. It means you need to try again. So how many do you need? How many great employees do you need to make millions of dollars? How many great lenders do you need to refinance dozens, if not hundreds of houses? How many great contractors do you need? Well, you just need one or two or three.
You need a handful, and then the rest will take care of themselves.
Right. So I'm going to go out on a limb and say, if you talk to 10 or 15 or 20, now, if you're lucky, like me, sometimes the first or the second one you talk to, they really want, I know my lenders really appreciate the opportunity to do business with me. And if that comes across arrogantly, I'm sorry. But I choose to view it like that. Like, they appreciate that opportunity. The way they act and the way they talk to me shows me that they really appreciate that opportunity. I'm not begging them for this. I'm just asking, hey, y'all don't do such and such, do you? And then y'all wouldn't be interested in doing a line of credit on that instead of a traditional, mortgage. Like, y'all don't do anything like that, do you? And it's just every time they're like, yeah, we would do that for you. Okay, cool.
Look at that.
So how about that? So that's some of the kind of disclaimers. Is it's going to be a shorter term thing. You're going to have to renew it every however often, whatever the bank says, and then which is a little different than a mortgage. And then the interest rate can change. The biggest question I get all the time, Greg, is like, well, can't they just call the note due? Like, what if they change their mind and they're like, hey, I just want to call that note due? My response to that is, if remember, this is a first position line of credit. In the bank's eyes, it works the same as a mortgage. In fact, when you do this the first time, you'll see that the deed, when they do a deed of trust or whatever they do, and whatever they call it in your state that you're in,
security instrument. Yeah.
Yes, it will look the same. So, I do this where I'll open up like we said, $150,000 line of credit, but it has zero balance on it. But it looks they call it a $150,000 line. Like, it's a $150,000 thing on the deed, because in their eyes, it's the same thing, because at any given day, I could take all 150,000 of it.
And they have the collateral.
Yes. And they have the collateral. So in their eyes, this is, in my opinion, I'm not a banker, but I know a lot of bankers. In my opinion, they view it the same way. And so the odds of them calling it due or not wanting to renew it after a certain time period or whatever, I guess there's a chance for that. But remember, they're in the banking and they're in the money business. They're not in the real estate business. So I guess they could call it due and want to take the property or something, but
they don't want to do it really ever, because it's a pain in the ass for them.
Yes, that's not the business they're in. Now, if they do, though, remember, and I have to remind myself of this, if they do, it's not like you're just hung out to dry. Remember, there's other lenders. There are still traditional mortgages if you want to go get one. They're not going to take the house tomorrow. There's still a process for things. You're probably going to be okay, right? The other thing to remember on this, Greg, is there's a nice little clause that we all sign off on every time we sign a mortgage, a traditional mortgage. And it's an accelerated clause that says we, the lender, can call this note due anytime we want. They reserve the right to call the note due anytime they want. I know you think you're locked in for 30 years, but there is a clause in there that we all sign off on that says they can terminate this whenever they feel like it and call the entire balance due. I know this isn't talked about very much, and I'm sorry to be the bearer of bad news for people. And I could be wrong. Read through your mortgage paperwork. Maybe it's not in there.
It's in. These banks are smart. They don't mess around.
They don't mess around. They're not messing around. They own the tall buildings for a reason. So, by the way, the reason that they own the tallest buildings, since I mentioned that so many times, the actual reason is we've already said it. So if we want to connect the dots here, the reason they own the tallest building in every town is when you go to put your $50,000 in the bank and they pay you 0.02%. But then, Greg, you're the same person and you go to that same bank and you want to borrow money, they charge you how much?
4%.
Let's say they charge you 4%. So this is my question. What's their ROI? So if they're paying 0.02%, but then they're charging 4% for that same 50 grand, what is their ROI? What do you think?
I mean, it's almost infinite.
It's almost infinite is the correct answer. So usually people are like, oh, it's 400% or it's 1,400% or
it's almost
whatever. The reason it's basically infinite is it wasn't their $50,000 in the first place. It was yours.
Yeah, and they're basically wholesalers, these knuckleheads. They're wholesaling my money.
We would call it like an arbitrage, right?
Spread game. They're playing the spread game.
Yes.
But
it wasn't their money in the first place. Now, it's not infinite because they do have overhead. In fact, they have a lot of overhead. How many times have we walked into a bank and there's 15 employees standing around doing who knows what they're doing and not one customer?
All the time.
Like, how can they afford that? Like, there's no other business I'm aware of where you'll ever see that. They would be out of business. This is how they can afford it, because they have like a bajillion% ROI. It's brilliant. It's absolutely
brilliant model.
Good for them. If we can do our best to not participate, and I'm not saying that in a weird way, but like if we can do our best to participate in a different kind of system, then I think I could be wrong on this, Greg. I think in 10 or 20 years, I think we're going to look back and say, okay, that was a really smart move because it made sense. The numbers made sense to do it the way that we're talking about doing it. So anyway, that's that. And then I think the interest, to put a bow tie, Greg, on the interest thing. So effectively, we think we're paying like 3.5% when we sign these 30-year mortgages at 3.5%. As we already said, $800 or $900 of the $1,000 is going to interest at the beginning. So what's the actual percent that we're paying in interest? Let's say on the first 7 years of the loan, what's the actual percentage that we're paying? It's not 3.5.
It's insane. It's like double that. It's insane. It's I don't know the specific number, but it's
well, if 800 is going to interest and only 200 is going to principal for the first 2, 3, 4 years,
you're paying almost 100%.
Wouldn't it be fair to say that it's like 80%?
80 to 90% interest.
If 800 out of 1,000 is going to interest?
Like 80%.
So, again, I'm sorry to be the bearer of bad news to people. Newsflash, the banks don't own the tall buildings because they're making 3%. They own the tall buildings because they're making like 80% on mortgages, and they're making like almost infinite percent on the money business.
It's insane. Well, you should have a campaign, make mortgages great again, Alan Biel.
Well, I will say that the system that we have here in the United States is so good, and I'm not meaning this sarcastically. Look, Greg, you and I wouldn't have even met. We wouldn't even have this conversation if it weren't for the freedoms that we have, if it weren't for free enterprise and capitalism and the desire that we have to grow and to build things and to become great at what we do. Like, there's a ton of stuff. I don't want to come across as like a doomsdayer or a naysayer or a negative person. Everybody that knows me knows I'm really not. I'm a super positive person. I'm just more interested in the average person like myself doing well financially as opposed to doing poorly. That's it. That's all I'm talking about here.
I love it, man. Dude, you are a freaking wizard, man. This was a master class on how to do HELOCs. You got so into the weeds in a good way. I mean, this has never been talked about on my show. We've had people talk about rentals and all that kind of stuff, but you got so in depth in the weeds. This is going to be a show that people I know for a fact are going to be re-listening to. This is going to be a show people are going to share because they're going to be like, dude, you got to hear this podcast. This guy, Alan, really knows what he's talking about. And I'm telling you, like, this is the kind of stuff. This is why I wanted to have you back on for a second time, because I remember we had this, conversation in Mexico a couple of years ago, and then we just unpacked that to a whole nother level today. And you're really opening up a lot of eyes to my listeners on how to do the rental property game in a different manner. And I really appreciate you for doing that, man. This was a serious masterclass on how to do that. And I appreciate you going so deep into the weeds on all of this.
It's been fun. I honestly, Greg, feel like people are going to get bored or it's too analytical.
No, they're not.
Have to watch it on that. I'm really more known as like a sales guy, like acquisitions guy, dispositions, love that stuff. I've coached hundreds of people on that to make large amounts of money. This is just like a little side thing that I've been working on the last couple of years that people seem to be interested in. But I'm down for talking about, I don't even remember what we talked about last time, but if there's anything I can do to help or bring value in any way, from marketing to acquisitions, dispositions, TC stuff, scaling, whatever. We can talk about it, but this was fun for sure.
Dude, this was awesome, man. So as we start to wrap the show up here, what if people want to connect with you, like if they want to connect with you, follow you online, what's the best way for people to reach out? Because I'm sure some people are going to be like, holy crap, this was unbelievable. How do I follow this guy, Alan?
Greg, I think you know this. You're probably I'm not easy to follow online because I don't really post very much.
I mean, like email or like whatever, something where they can get in touch with you.
Email me, Alan. It's Alan. That's ALAN @realestatescaling.com. That's one of my companies. I'll be honest with you, Greg. I don't have anything to offer. I don't have a program. I don't have a course to sell. I do coach a very, very small number of decently sized real estate companies and owners of companies. Not necessarily beginners, but people that are already doing well and
money, yeah,
scale up, yeah. So I've done pretty well at like helping people, get from making $10 or $20 or $30,000 a month to making 50 or 100 or a couple $100,000 a month. I enjoy that part of it. I've recently scaled down my coaching company, ironically, to coach a very small number of people, and I actually coach them personally because I've become aware these last couple of years that I really enjoy that part of it. But I would say just email me, Alan @realestatescaling.com. That'll come to me and my assistant. And really, if there's anything I can do to help, I'm happy to give you my feedback or whatever. I do enjoy helping people. But hey, I didn't tell you this before the show, Greg, but I got off the phone yesterday with a client who, when I started coaching, this is going to sound crazy, but I'm so proud to because you and I were talking about, because I know you do some coaching.
Yeah, a little bit. It's kind of like you. It's like a limited scale. Like it's not like a full-fledged kind of thing, but it's like when it makes sense for them, and for me, we do it.
Yes, and you get asked, I'm sure, about it quite a bit.
Yeah.
But this is crazy, Greg. So this client's been with me for 2 years, just over 2 years, like maybe 2 years and 2 months. And when they started, they'd been in business for 5 years when they started with us. So they were not newbies. They were doing pretty well. And all they were asking was like, if you could help us, we're averaging like $45,000 a month wholesaling right now. If you could help us get to like 60 to 80,000, we would be forever grateful per month, right? Because that's a lot. That's like $250,000 extra per year.
Yeah.
So anyway, after probably 6 or 9 months or something like that, I remember they were like, "Hey, we're over $100,000 a month," and we were just so excited for him and his business partner. And then, but he was like not going to stop there. So then, after like a year, probably 15 months or so, they were at like 250,000 a month, consistent too. This is not like, oh, they had one $200,000 month.
Like they're doing it every month.
Anyway, so I got off the phone with them yesterday, and they just closed in April, which was just a few days ago. They finished out April at 800,000 in profit, and they're on track in May. They've got $1 million on the board. So amazing. That is unbelievable. I mean, can you believe that? Like to have seen this happen, and this is in 2 years. I'm not guaranteeing that. I don't know if this will ever. Can I just say disclaimer after disclaimer? I don't know if this will ever happen again for anybody. But Greg, you and I both know people that do make that kind of money.
Oh yeah, we know a lot of them.
But to have seen that after they had been in business for 5 or 6 years already before we met them, and now to have seen that happen firsthand. Like I was talking to a different client last night, and they were like, "Hey, so-and-so is doing such and such." And I was like, "Yeah, they are." And they were like, "Can you please tell me how?" And so I listed all, I said, well, on month 3, we kind of did this, and they had problems with that. And on month 6, anyway, so I was listing all of it out, and but it brought back all these memories. It's just, isn't that crazy? You do coaching.
That's amazing.
That's ridiculous.
So fulfilling to see that and hear that, and it's like, having a piece of it, being able to contribute. It's just like, can't put a dollar amount on that. It's like that feeling of being able to help and see how their lives obviously have changed now. If you're making, 800 to $1 million a month, I mean, that's serious money. You should be proud of yourself for helping them. Serious, man. Well, that's the real deal.
And plus this too, Greg, because I was thinking, because I know you spend a lot of money on coaching and mentorship and mastermind groups like I do. I was thinking about this too. what's the ROI? Like if I pay a mentor 50 grand to coach me for a year, which for high level mentors, that's not that much, but I'm just saying that's a round number, 50,000.
Yeah.
And over the course of a couple of years, if they take me from 50,000 a month to, let's just use small numbers. If they take me from 50,000 a month to 100,000 a month, what's the ROI on that 50,000 investment in a mentor? It's like 12 to 1, right? I mean,
12 to 1, like in terms of ROAS, if you're doing like a marketing thing, like the return on spend, not ad spend, right? A little Frank Kern there. Yep. It's like every time you gave $1 in and you got 12 back. I mean, what can that do to change your life? To buy the rentals, to do the lines of credit. I mean, just having access to that capital is life-changing. It's absolutely life-changing.
Isn't that crazy? So like people look at the 50,000 and they don't look at the, it's like, hey, they're taking people from 50,000 a month to 100,000 a month, like per month.
It's doubling their business.
That's 600,000 extra dollars per year. But here's the thing, I don't really know what the ROI is on it, because when you hire somebody like that, and you've done it, I've done it, you can make an extra couple $100,000 or 600,000 or $1 million, whatever, because of that person or whatever, if that's who you want to give credit to. But for the rest of your life, you get that knowledge. For the rest of your life, you get those skill sets. They can never be taken away from you. The industry can change, iBuyers can come in, all this stuff can happen, but they can't take away all the marketing knowledge that you gained, all the sales knowledge that you gained, all the investment knowledge that you gained can never be taken away from you. So I don't really know what the ROI is, but anyway, that's what my brain, I was like, God, they have like 1,000,000% ROI on what we charge them for coaching. And then I thought, it's actually more, because they have all this knowledge that they otherwise wouldn't have had.
And the knowledge is an actual asset. That's the most important asset you could ever have, is your skill set and your experience and what you've learned along the way. So like these gentlemen that you coached, or females, whoever, I got to be politically correct nowadays, you can drop them off, this is ridiculous, but you could drop them off in a random market in the middle of America, and they will be making money hand over fist in 90 days because of what they learned and who they've become and what they've developed from getting involved in coaching and training and mentors and acquiring skills, as Alex Hormozi would say. So, man, Alan, you're doing a lot of great things in this real estate world. You opened up a treasure chest of knowledge today on the show. Alan at Real Estate Scaling. We'll have that in the show notes, man. And I always appreciate you on my show, man. You provide so much value, and it's always a pleasure to chop it up with you, my friend.
Thanks, Greg. That was fun.